Hi, everybody. Bob Iacchino, co-portfolio manager of the Stock Think Tank. Of course, along with Mike Arnold, it is February 1st, and we've got our first month in the books for 2021 for the Stock Think Tank core portfolio. And I'm happy to report that if you followed our alerts and used your position sizing tool, got in around where we told you to, got out around where we told you to, and used the approximate same position sizing that we use in the core portfolio, which you don't have to do, but we have to track it somehow, right? And if you did that, you would have been up around 5.9% for the month of January. That's at the same time that our benchmark, the index that we track ourselves against, the SPY, which is the ETF version of the S&P 500, was down 1.05%. So we got a good over 6% lead on the S&P 500 for 2021, which we may need. If you're tracking the core portfolio now, part of the reason we were up when the stock market took such a beating at the end of the month is because we do what I repeat on many of these weekly updates. We take profits and then we look for new trades. So we had cash in the bank when the other stocks, or I should say the index rather, started collapsing based off of some of this excess volatility driven by the gamma squeeze and the short squeeze in GameStop GameStop. Sometimes I say GameStop. In GameStop, AMC, Cause, some of these others. Do you guys want me to talk about that? I mean, I guess I could talk a little bit about that, explain a little bit of what that is, but I think it's been done over and over and over again. A lot of people are right about what's going on. A lot of people, I think, are really wrong about what it means. But back to the portfolio. We have a huge head start because we take profits, and we may need it because now, February 1st, as I speak to you, I always do these before the market is closed, at least I try to, and the market's up quite a bit, about 1% for the S&P, 1.5%, around 2% for the Russell and the NASDAQ. So we're up today, but in the Stock Think Tank, because we got out of Best Buy this morning, we've only got two stocks on. It's Aflac, which is profitable and about $2 and some odd cents away from its target. And Cisco, which we got in on the 28th, which the last I looked was down about 12 cents. So we've only got those two stocks to try and follow up and beat the S&P. It's likely that as we start off February, we're behind. But as I mentioned, we've got an over 6% lead on our index, and that's going to serve us well. And we've got the rest of the month to fill in the portfolio and get some of those good solid movers with that risk per trade that we do in the core portfolio, which had us outperform last year by, well, if you look at the difference between the two, it's about 250% we outperformed by, a little bit more than that. But it's about 26% versus about 60, it was about 62 or 63% that we did last year. Don't quote me on that. It's all over our newsletter. Or the newsletter that'll be coming out in a couple of days. So, in reference to GameStop, let's just use GameStop. What happened there is called a gamma squeeze, and that turned into a short squeeze. So what is gamma? Gamma is the speed with which a particular option's delta moves. Delta is the percentage of the stock move that will affect the option move, basically. That's basically what those are. You can look at them in a number of different ways, but that's what those are. So when you have a gamma squeeze, you have far out of the money calls being purchased. They're being bought by somebody in big numbers. And that's causing market makers in those stocks, and by the way, they're forced to make those markets. They have to make those markets. So as far out as options are being requested, those market makers have to make the markets. It's per FINRA and stock exchange rules. And then they have to hedge a portion of that position. So if they're short calls because somebody's buying those calls, then they have to protect themselves by buying the stock. That triggers more buying, and it's a price insensitive buyer, right? Somebody who doesn't really care at that moment where the price is, they just need to hedge. And then that causes potentially the shorts, people who are short these stocks, to be underwater by a lot, and they need to start covering, and it becomes something of dominoes, right? A domino effect. Now, the good thing for me on a personal level is I don't mind seeing those hedge funds get beat up. It doesn't bother me one bit. Some of those, and I'm not going to name names, I think are pretty nefarious actors myself. but I don't believe in manipulation of price in any way, shape, or form. So if a bunch of people or a bunch of hedge funds or a bunch of banks or a bunch of retail traders on a message board are banding together to try and manipulate a particular situation to happen, that to me is manipulation and is not legal, or it's not kosher per SEC rules. Having said that, I don't really care if some of these hedge funds go out of business. I'm not really a fan of a lot of these guys personally. So anyway, that's what's happening, or what has happened. And it's calmed down a little bit, and we're getting a little bit of a move from the market. But also, you've got Republicans presenting about a $600 billion COVID relief bill to the president, to President Biden, and President Biden is considering it or looking at it. So now the market's starting to look at a smaller relief plan, but maybe a faster relief plan or a bigger relief plan. It's a mess in government. So we're going to keep doing what we do. I probably say this every week. We're going to look for these well-positioned trades, these well-positioned active investments, to be able to give us the outperformance that we had last year, and then again, the outperformance that we had in January. You're seeing right in front of your eyes how this process works. Okay, we take profits, and then when the inevitable exogenous shock happens, we've got profits. Now, if the sell-off continued, we likely would have gotten hit on Best Buy. We ended up getting out at a small profit. Probably get hit on this new Cisco position. Probably get hit on Aflac. But we already had a certain amount of money in the bank. So the further the S&P fell, the further that 5.96% that we returned in January would have fallen as well, but it wouldn't go to zero because we had cash in the bank already. So that's how this process works. That's how the stock think tanks works. That's how Mike's analysis works, and the two of us teaming up to pick these stocks for you. So again, stock think tank core portfolio doing great, up near 6% in January when the S&P 500 was down 105. So that's what we're trying to do. That's what we did for you guys. Watch for the newsletter. It's going to be out in a couple days. There's some really good stuff in the newsletter. And again, look up the way that a gamma squeeze happens and the way that it develops. And if you're going to play in those stocks, first of all, I would say don't. But if you're going to, because you're all adults and we treat you like adults, do me a favor, use the money you were going to bet on the Super Bowl, or use the money that you take to the craps table or to the blackjack table, because it's basically what you're doing. We are talking to investors. We in the stock think tank, we're looking for and talking to investors. If you're going to do that stuff, I'm not going to judge you. Use your craps money. Good luck to the Tampa Bay Buccaneers. Good luck to the Kansas City Chiefs. I'm going to be watching either way. Cheers, everyone. I'll talk to you guys next week.